Envelopes. Envelopes consist of a 2.5% band, which can be found above and below the 20 SMA line. The distance between the bands is almost always the same, and envelopes are often used in trading ranges. When the bands cross, that becomes a trigger to either buy or sell the stock. Now, a problem with envelopes is that they don't account for the changing volatility of the underlying asset, and so you might be comparing apples to bananas. So with that, I urge caution. Then we have a very similar concept, which are bands, and bands actually correct for the error of the envelope, which is the change in volatility. And so instead of using a 2.5% band above and below the 20 SMA, it uses plus or minus the standard deviation. That's pretty cool. And as we're going to see in a second, that's the concept that's going to be used in the Bollinger Bands. So the meat of the video is the Bollinger Band. So the Bollinger Band is not plus or minus 2.5%. It's not plus or minus 1 standard deviation. It's plus or minus 2 standard deviations of the 20 period SMA. Now, what's really great about Bollinger Bands is that they perfectly account for volatility. So if there is more volatility in the stock, the bands are going to widen, thus decreasing the probability of false signals. And conversely, if the bands are tightening, that means that the volatility is shrinking and that you should probably expect a sharp move in the future. When the outer edge of a band is broken, empirical evidence suggests that you should buy the breakout, just like you would do with broken resistance. That's one way of trading it, but some people also use Bollinger Bands as support and resistance levels, and that's what I do personally. Now, why are Bollinger Bands great tools to use is because of the statistical significance of what's about to happen next. And so with a plus or minus 2 standard deviation, say we are to touch the upper band, from statistics, we know that approximately 95 of all price action should fall between the bands. Therefore, if we touch the upper band, there's a 95% probability that the price is going to go back below the upper band. So short the upper band, buy the lower band. Not financial advice. You make your own investment decisions. And of course, as with any technical tools, the best thing to do is to combine it with other indicators like moving averages, for instance, or momentum indicators like the MACD. So there you go. That pretty much wraps up my video. I hope that you found it useful. And if you did, I would really appreciate a like from you. Thank you so much for watching.